What's going on, everybody? It's Jeff here. Welcome back to the channel. I hope all of you are having an amazing weekend. We have a very exciting and potentially volatile week ahead of us. I wanted to come on here to talk about a couple things. One side is going to be the potential downside catalyst, which could lead us to further deep in the red, and also a couple of the upside catalysts. And the reason why I'm making this video is I know a lot of you, especially everyone inside the group, has quickly been able to switch gears and adapt to the market pulling down. We're playing our puts, we're shorting, and we're still coming out profitable. But it's very easy to get complacent. And I want to be able to talk about what to keep an eye on ahead so you can prepare very well if the market does turn the other direction. I'm going to break everything down for you in this video. Let's get right into it. We're going to talk about a couple things that are going to be the downside catalyst. First, the FOMC is going to be meeting on the 26th. Now, every time the Fed meets, we know there's a little bit of volume slowing into the meeting. All right, and it tends to be a little bit of a sell-off. However, a couple things to look at. Okay, and this I have highlighted here. This is a statement from Jerome Powell. As we move through this year, if things develop as expected, we will be normalizing policy, meaning we're going to end our asset purchases in March and we'll be raising rates over the course of the year. Analysts and investors expect Jerome Powell to just reiterate that statement, still saying that, yes, we are planning on March, so long things do not change. Okay, but I don't believe he's going to come out and immediately say, in March, here it is. That's the vibe that I'm getting from everything I am researching all over the internet. And that March meeting is going to be the one that is very crucial. The other thing I want to talk about, however, which could be an upside catalyst, is the financial markets are now starting to fully price in a March rate hike. You've seen, and we're going to take a look at charts, a little bit later on, but you've seen 6 to 7 days of just massive selling off. The NASDAQ is about down 10%, I think, in 6 days. The SPY is down about 8% in 6 days. Those are massive drops in such a very, very short period of time. So keep that in mind. I know we always talk about the FOMC, and especially when they meet. The other thing I want to talk about is the earnings this week. Okay, this is going to be monster week for earnings. You have big tech. You have a bunch of companies that make up a good portion of the Dow Jones, IBM, Boeing, Tesla, Apple. You got a lot of big guys in here. And we saw what happened with Netflix last week. All right, they came out with positive earnings. They even said that their subscriber base is going to grow, just maybe not as much. And investors didn't want to hear it. Okay, so keep that in mind. Everything is going to be looking for, on quarter one. All right, it's going to be like they're writing off quarter four. Doesn't matter what you did. Tell me what you're going to be able to give us. And if any of these companies give any slight indication saying, listen, there might be a little less traffic due to COVID. All right, there might be a little bit less revenue, projections due to the supply chain issues. Investors are really, really going to, rate this in a very high scale and have a very close eye on everything they're expecting for quarter one. So expect some of these companies, if they do not come out and say, yeah, we've got everything under control and we're going to continue to give you dynamite numbers in order to, keep this high valuation credible and rewardable, investors are going to pull quickly. So if you are holding any of these companies, prepare that going forward. Now we are going to talk about the other side. Okay, and there's a couple things that I see happening here. First off, you see the SPY has hit a very, very critical level, this 438, 439. It's a 200-day moving average. We have not breached down to that in quite some time, okay, all the way back since, March of 2020, when the COVID lockdowns began. This is a very crucial number, all right? We also have not seen any relief whatsoever. I'm going to zoom in here a little bit. There's been no relief. All right, you do have this green candle here. However, there's been no relief. It's just been straight, rapidly going down. All right, and I do believe we are going to get a little bit of a bounce happening. My other reasoning for this is take a look at the treasury yields. Now, the treasury yields go hand in hand with the stock market. All right, a lot of times when the treasury yields rise, stocks begin to pull back a little bit. It's a little bit more enticing for investors to throw their money in bonds when the rates are a little bit higher and they don't have the risk. But take a look what you see happening. I'm going to focus on the 10-year and the 30-year. all right, from January 3rd all the way up until the 18th, 19th, it was steadily increasing. The 10-year every day, the 30-year, the same thing. And once you get here to the 19th and the 20th, it stagnated. It pulled back a little bit, 1.87 to 1.83, 2.18 to 2.14. Okay. And it stagnated for those 2 days. And on Friday, you saw the rates drop. This is the first time the rates have dropped since some of the pullback that we've seen inside the market. Okay. So think about that going forward. The other thing I want to mention, and this really has all to do with retail, is going back to what I said at the start of this video. I've watched everybody, including myself, adapt very, very quickly. All right, we've been playing the shorter game for six to 8 months now because of all of the uncertainty that is going on inside the markets, inside with the Federal Reserve, the economy, everything. So we've been playing the short game. All right, big money knows that. Institutions and funds, they know that retail's been playing the shorter game as of the past 6 to 8 months. Okay, so I think that, and this is almost a feeling that I'm getting, that because they see, and I see as well, that retail has adapted so quickly to the market selling off, playing the short side. Okay, the amount of call flow that was happening when the market was at all-time high was insane. The amount of put flow that is happening now has that pendulum has rapidly swung in a short period of time, that investors are going to come in. They've got some of their money on the sideline. You've got some good deals happening on stocks that are down 20%, 25% in a very short period of time. It's not going to surprise me that you're going to get a surge of money coming back into the market to get a hard bounce. Okay. So I understand everything I just kind of said in this video, that two things could happen. Obviously, it's always one of two things that can happen, but there are both downside and upside catalysts. I do expect to see some relief. And I personally feel that this January FOMC meeting isn't going to be one that everybody's going to have the eyes on. Okay, the market's already pulled back. It's adjusted to a rate hike. They want to know for sure whether the rate hike is happening. Now, if Jerome Powell announces that now, then yes, the market is going to get a little bit of a shock that happens to it. I think we might pull back a little bit further. However, I think there's a lot of uncertainty that can happen in the next 2 months to where it would be kind of really premature for Jerome Powell to announce that. Okay, when it all takes is a quick flip of a switch for them to get to that quarter point, raise. And that's why I think March would be the one to really keep a close eye on. All right, but just pay attention, because I do think we are going to get some relief. I don't think that it's going to be that, over. We've seen bottom, but I do think we're going to see a little bit of a bounce. So guys, that's it for this video. I'm excited for the week ahead, and I'll see you in the next one.